We'll get going because there's plenty to go through. Welcome to Trending Treasury. For those that don't know me, I'm David Blake, and I'm joined today by my colleague Nick Keeling, also from Arling Close. So welcome along, Nick, and welcome along to everyone. Thanks for tuning in. Yeah, I think this session is going to be quite long because it's quite involved. There's quite a lot of details. There's quite a lot of moving parts to this, and there's quite a lot of uncertainty still around certain aspects of it. So it's booked for half an hour, but we're going to be here longer than that, well into an hour, I would have thought. And please do fire in your questions as we go along. It'd be interesting to see your views on the PWLB consultation and the response to that. So we've prepared a few slides. Hopefully you can see those. But I thought I'd start off by asking Nick a question. So, Nick, what do you think the key takeaways from HMT's new guidance on PWLB and the response to the consultation are? What do you think the key points are?
Yeah, thanks, Dave. Morning, everybody. Well, clearly the main one is the lower rate, which I'm sure everyone was very, very pleased to see after what's it been? It's been a year, hasn't it? A year of elevated margins, very expensive margins as well. I hasten to add, we've come back to the pre-coronavirus level, but obviously it comes with strings attached. Which I'm sure we'll go into some detail over the rest of this webcast. So the lower rate, 80 over, certainty rate, same level as the HRA rate for those that are complying with the new rules. I think the other point is it's available immediately. There's a bit of confusion, especially the speed at which they issued and implemented the new rules. We had the consultation on the evening or the afternoon of the spending review, and it was being implemented the next day. So very little time really to absorb the consultation response and the new guidance. And it seemed to suggest you need to submit more information before you could get involved. They reopened the certainty rate form that had already been submitted for this year, but the message was actually it's immediately accessible. So as long as you can confirm or affirm maybe that you aren't undertaking PIAPY, purchasing investment assets primarily for yield, then you can get right into the PWLB. You can borrow straight away and borrow 80 over for HRA or non-HRA. So yeah, I think many of our clients probably will have gone into the new reopened certainty rates and possibly amended plans, maybe taking things out, maybe moving things around. Others may not have done so yet. I think we might cover this later, Dave, but I'm not sure what the immediate need for PWLB borrowing actually is, given where most of our clients are. But I'm guessing not many are jumping in immediately.
Yeah, I think you're right, Nick. I think certainly we will be covering the strategic aspects of this and what local authorities need to do now or need to do before Christmas, which may be not that much given some of the wider economic context. But thanks for that summary, Nick. So yeah, any surprises in the consultation? Anything new? Anything we weren't expecting?
What were we knew, I suppose, about the debt, the renamed purchasing investment assets primarily for yield. We knew that was going to be in there. There was no surprises there. Maybe some surprise around the edges, perhaps, but I'll cover that in a second. I think the main point was we were quite concerned, and I'm sure many of our colleagues were, and many clients were, that by removing access to the PWLB in totality, it does impinge on the creditworthiness of the sector to somewhat. You can't, if the sector can't rely on that being there, what will other investors, what will lenders think? What will be the assessment of the creditworthiness of the LA sector? So that was a concern for us. And I think that's something that perhaps the Treasury saw and have actually responded to. So one thing they did include was that if you're refinancing or indeed externalizing internal borrowing, the PWLB will still be there for you, even if you're locked out because you're undertaking PIA, PY. It's rolling off the tongue now. So it's not quite as total as perhaps we considered, but it's not quite as easy as the guidance made out, at least in my opinion. And we can perhaps maybe cover that later, or perhaps one of the first things we cover. But that's perhaps the main takeaway. The other issue here is this preventative action, which was actually included as part of the regeneration and consultation, part of the regeneration section. But they've carved it out. They've made it into a separate section. It's hard to know why. My own feeling of it is that they were worried that preventative action could be anything. Really, it could be buying the town centre to ensure it's so it doesn't decline, and so it could cover quite a lot of what maybe they think is PIA, PY in another form. So what they've done, they've put it into a separate category and put some criteria around it. It shouldn't be big. There's a real size issue there. It should have an exit plan. So loans or kind of help to enable services to stay open, perhaps that wouldn't otherwise do so without intervention, is fine. But getting involved in something that the private sector may well get involved in itself, even if it's completely to change the use of an asset, is a no-go for that particular category. So that was quite interesting, actually. I think that's probably more nuanced than we perhaps realised when we included it when it was included in the regeneration factor. And also looking at debt for yield, I don't know. Again, when I read the guidance, it seems to have narrowed a little bit. So it's now purchasing investment assets primarily for yield. It's buying assets that already exist in many ways. So whether this is slightly narrower than it was, I don't know. I suppose only time will tell, but it certainly feels that way.
Thank you, Nick. I was just reading. We've actually had a question in already from Dan Bates on defining purchasing investment assets primarily for yield, and this is the key to it. Probably should just give an outline of our discussion with HM Treasury following the announcement. HM Treasury are very good about talking to us after announcement. They wouldn't give us the time of day before, but for obvious reasons. But they're quite keen to explain their thinking, and it was clear from our discussion to me, Nick, that this is a high-level set of principles, and HM Treasury do want local authorities to have control of this, have the ability to decide whether they're conducting that prohibited activity and put parameters around that, and have the Section 151 officer decide what is and what isn't acceptable within the guidance and the framework given. So it's a high-level set of rules, which means there are a lot of unanswered questions. There are a lot of sort of imponderables. What if it's this scheme? What if it's that? And it is ultimately going to be down to the Section 151 officer to decide whether a purchase is primarily for yield or whether it's delivering one of these other service benefits. And I'm sure most on the call, if not all, will be very familiar with what a local authority does and what a local authority is meant to do. So it provides education and recycling and care and roads and emergency services. It's responsible for regeneration too. This preventative action that Nick's mentioned that has been carved out from the regeneration category, I think really to help define that more precisely, and housing and HM Treasury have been keen on housing for a while, delivery of housing, and indeed housing within the HRA, where that was already funded at a lower level following the March 2020 budget. So going into your question, let me see if I can get to the bottom of your question, Dan. So if a property is let at market rates and provides environmental improvements, is it going to be captured as purchasing an investment asset primarily for yield? I think it's really difficult to answer, and Nick and I were batting around some of these earlier, and the conclusions were, well, we need the detail. I think you need to look at the detail, and I think where it's a project that's perhaps delivering environmental benefits, well, I think we need to look at the context of those environmental benefits. Are they local? Is there a specific requirement for the local authority to be delivering on that? If there's a yield element, how important is that yield element? Is it all about yield, or is yield incidental to enable other aspects to continue, and to really take some sensible decisions along those lines? Also looking at the scale and the scope of the project, and be the trickier ones to establish. I think there's a lot of chat around these fringe projects that may or may not slip into buying investment assets for yield, but it is going to be down to the detail and ultimately down to the Section 151 officer to decide. But HM Treasury aren't that keen on the detail. I mean, the data they're going to collect is very high level. You don't need to provide any additional data this financial year. You just need to confirm that you're not proposing to purchase investment assets for yield, and you can access the lower PWLB rates now. So that's the good news. You will be required to fill in an extended certainty rate form effectively to provide more detail on categorizing spending across the areas we've listed on slide 2: service delivery, regeneration, preventative action, housing, and refinancing and treasury management. So you'd have to say how much you're intending to spend in those areas, and how much debt you're expecting to refinance with PWLB too. But it shouldn't be that difficult to get that together. And I don't think there's going to be a huge process at the Treasury in terms of trawling through that and ensuring everyone's complying, that it's a system that will rely on trust and the professional expertise and reputation and credibility of the Section 151 officer. However, Treasury have said that if they do find out that there are authorities pushing the boundaries or breaking the rules, that's when there will be extra analysis, investigation, and that's when some of the penalties that the Treasury include will come into effect, and we'll come on to that later on. But do you think that's fair comment, Nick? Do you think I've misinterpreted any of that, or is there anything you'd like to add?
I think that's totally on the ball. I think professional integrity is where the Treasury is laying most of the weight on this. To be honest, that Section 151 has a duty and also has the professionalism driving professional qualifications, and also the role as the financial custodian of the council to some extent, and they're relying on that judgment and that professionalism. I think it's interesting that the guidance does make reference to auditors being involved, not particularly specifically, but does suggest that the auditors have a role in, I don't know, auditing the capital plans to make sure there is no PIA, PY. I wish they'd come up with a shorter name for that. But anyway, so and is that before or after? So are they auditing capital plans before to make sure that there isn't, or will they be auditing borrowing activity after to make sure it hasn't been done for this purpose? And then is there some kind of Treasury hotline of which do they go via the council, or do they go straight to the Treasury?
Line, Nick.
Yeah. I mean, there's very little. there's no kind of detail around that at all. It's just, as you said, that the Treasury set out some guidelines, and in some areas they're lacking a lot of detail, and so we will fill in those guidelines as we go along.
But we were talking earlier, Nick, and then this links into a comment that Chris Brains posted. I don't know Chris, but I did read his blog that he posted on ways around the rules and regulations and how to circumvent the PWLB are proposing and continue to purchase investment assets. Let's call it that, Nick, to keep things simple. But that does, some of those techniques will potentially go against the spirit of this, of perhaps the prudential system and this self-regulatory guidance and code. And it is guidance the PWLB have introduced. I have some sympathy with the Treasury in terms of, well, they have tried to introduce a system that isn't very bureaucratic and does rely on the judgments of local authorities, and they're trusting you, local authorities, to make sensible decisions to retain access to what is a fantastic facility in terms of borrowing. It does have some faults, and we're going to that later on at PWLB. But getting access to funds, you can still access funds within 2 days' notice. It is at a market rate, and I was speaking to someone yesterday who was arguing that actually at gilts plus 80 on new funding, that's below market rate for many local authorities. It's a subsidised system if you want to look at it that way. Yes, there are some highly credit-worthy local authorities, the strongest authorities borrowing in size that can potentially beat gilts plus 80, but a lot of authorities would struggle to get that level. So to have that facility there, very few restrictions for those towing the line, and predominantly business as usual for those authorities, that is fantastic, and it gives you a great freedom to your plans and get funding in 30-year rates at 1.6%. Happy days. But have a think about whether you want to preserve that or how much you want to put that at risk. And I think those authorities that do continue to pursue those commercial agendas that don't deliver other benefits, or there will be some that sail fairly close to the wind on this, but I think the sort of more blatant schemes and the more blatant attempts to circumvent the system are going to be hammered down on. And it won't just be Treasury. You've got MHCLG coming to get you, don't forget, with revisions to the Prudential Code and potential caps on expenditure ultimately. So I think if they don't get you one way, they get you the other. So I think it needs to, perhaps the way forward is more thought on projects and what they deliver and how they can deliver value and yield, but also tick the service and regeneration boxes as well. So it's not just about buying assets; it's about developing assets and adding to that process, which I know Chris touched on in his blog. But that's my view anyway. I don't know if you've got anything to add on that, Nick.
No, not at all. Actually, I think you're quite right. The narrative. I'm sure there are lots of projects out there that have been viewed as, debt for yield or whatever you want to call it, but actually with a bit more thought, they can be subsumed into or made more of, so it becomes less about the yield and more about the regeneration aspect. So I don't know how easy that is for some projects, but for many that should be doable. So this isn't putting the kibosh on some of this activity, but it does need to be repackaged and rethought about, which is exactly what you said, Dave.
Okay, thanks for that, Nick. And I think in terms of some of the other questions, we may go through at the end and try and mop up some of the project specific ones and sort of toss those around, but we're just sort of move through some of the other points. And one of those are sanctions. So what happens, Nick, if you're on the naughty step? You think you were doing okay, or perhaps you didn't think that, you thought you might be caught, and you've got HM Treasury on the line saying, hang on, what are you doing? What are you up to here?
Well, that's interesting. There's a, if you look at the guidance, there's a before and after. I'm not sure how before is going to work. Again, maybe that goes back to that snitch line you talked about, Dave. But if you do apply for a loan and the Treasury do think it's a little bit suspicious, then they will get in contact with you, possibly, and ask for more details. And if they're happy, then they will advance the loan. And if they can't find the comfort in your responses, that then they can refuse the loan, and not just refuse the loan, but refuse access to PWLB in total until that project is perhaps removed. So that's kind of during the process. After, it becomes a bit more interesting. So again, if they think that you've borrowed suspiciously, or for a project that they believe is purchasing yield assets, then well, first of all, they can review the rest of your capital plans, and they will ask you for anything else that could be contentious. And they can ask for those to be removed, as well as the scheme you've already borrowed for, of course. They can ask for what's interesting is they can request the scheme that you may have already spent money on to be unwound in some way. And ultimately, they could ask for you to repay the debt that you borrowed for that at whatever the market rates are at the time. So, if interest rates have gone down, it will come with repayment penalties due to the way the structure of the PWLB new loan rates and repayment rates are. So it could be quite costly to do that.
Indeed, Nick, indeed. So I think in that context, we sort of came up with a process and a fairly obvious steps, perhaps, that locals may need to go through. Hopefully you can see slide 3 here. And that is, compliance with the new guidance and system. You're going to need to define your activity, first of all, not this financial year, but certainly in preparation for next financial year. So you need to be doing that soon. Categorize your capital expenditure and look at how much you're looking at refinancing and need to borrow for treasury management purposes. And I think also do a risk assessment around that, and a risk assessment. Well, if I've got a project in here that's looking a bit dodgy and it does get caught out, and then I can't fund any of the other aspects of my capital program, albeit I may still have a lender of last resort. What are the risks to my authority of doing that, reputational and financial? So then we're into sort of exposures and quantifying that, and quantifying the cost of not complying with the PWLB. Yes, we've got this lender of last resort clause, but it does look to me like it was shoehorned in at the last minute. It doesn't quite flow with the rest of the documents. And there's, for instance, when you answer PWLB's questions on why you're borrowing, you have to confirm that you don't intend to purchase investment assets. So if you say, oh yes, I'm going to be purchasing investment assets, but I also want 100 million to refinance this debt that's maturing as well, that's a difficult conversation. There isn't a form for that. And I think at that point, Treasury are going to get involved and say, oh, so you need to refinance. That's great, but let's have a look at this project that's causing the problem. Perhaps you need to think twice about that, or think about unwinding that, or so there's some other sanction that sits alongside it. So, Nick and I were talking, you're kind of either in or you're out of this. I think there may be a halfway house in emergencies. But if you do want to pursue the projects, you probably need to start planning for a life without PWLB for the period that you're conducting this activity, and also be prepared for those other sanctions we mentioned as well. So I think it can happen.
I think that's
certainly alternatives.
Dave, that's a really good point. I mean, we haven't covered that kind of refinancing clause in the guidance, and you've just talked about it, and I mentioned it earlier. In the guidance, it seems quite easy. It seems quite open. It almost seems like a back door. But when we spoke to the Treasury, they're very much of the opinion that no, it is a lender of last resort option. They don't want they don't want the new rules to cause a liquidity crisis at a local authority, and essentially send, have catastrophic implications. So they're very much saying that the PWLB is there for refinancing and externalising internal borrowing, but very much gave the impression that that would generally be after you've exhausted all other options, so that there's almost nothing else available. Of course, we don't know. Dave, you're on the call with me. We don't know how far they take that. But I suggest, like you've said, it's not a conversation you'll have with the PWLB. It's probably a conversation you'll have with the Treasury first before you go to the PWLB. So that was quite interesting. It's not a message that the guidance kind of conveyed.
Yeah, and then there is a risk reduction piece potentially. Look at your project scopes. What is the contentious part of any project that you're pursuing? Do you need that? Can it be reshaped or changed and modified in some way so it's more likely to tick the boxes and reduce you getting caught out by the rules? And I think scale feeds into that as well. What is the scale of that particular aspect within the context of your overall capital plan as well? And then we are into potential areas where you could game the system. I mean, the system's so broad and wide, there's loads of opportunities to do that if you want to. For example, on the timing, potentially looking to replace internal borrowing and refinance ahead of. Oh, sorry. Did I not mention we've got this huge commercial investment scheme as well that you then show the Treasury at a later stage? But that's probably sailing fairly close to the wind. Again, it's outside the spirit of the guidance, and it potentially jeopardizes PWLB access for your authority and all other authorities, that kind of activity. So I think you would need to think carefully about pursuing that and withholding information from Treasury and yes, trying to game the system like that, or indeed funding commercial investments with short-dated local-to-local loans, and then looking to refinance at a later stage with PWLB. I think that it's possible, but it may be tricky. You may get caught out. But we also thought about the funding structure and actual, those penalties. And yes, it will be frustrating and potentially quite difficult for some authorities to lose access to PWLB. But during the year, what I call the year in the wilderness, when PWLB rates were very high, we had a year where hardly anyone borrowed from the PWLB anyway, and the world kept on turning. There was plenty of activity in the local-to-local market. We saw the bond agency issue. We've seen plenty of private placements, and we've seen interest rate swaps as well. So the market innovated and evolved and actually operated quite well without PWLB. Now, whether it could do that on a long-term basis at the same levels, I don't know. But there's certainly life outside of the PWLB. So you're into things like funding structures and even PWLB loans. You can put together quite a comprehensive structure that minimises your risk in terms of redemption penalties if the Treasury want to come for you, and that would be one of the key costs. So there are ways of protecting yourself doing that. And then, of course, we're into those alternatives that I've mentioned as well, plus structured finance, things like income strips and other forms of debt that could be used if you really want to continue to pursue these projects. Or perhaps even if you don't, we're still seeing value and rates that are potentially lower than even the new PWLB rates. So that aspect isn't completely dead. And yeah, just looking at some of these bond spreads, and we've shown this to you numerous occasions, but we're tracking the spread on local authority bonds above UK gilt. So the spread above gilt yields for a variety of public listed bonds. So Lancashire bond here, the 2025 5-year bonds trading below 60 basis points over gilt, so inside PWLB. And also they've got a 2060 40-year issue that's around gilts plus 80 as well. But I think we should highlight a couple of points on that. One, not every authority can issue in that kind of size and get that kind of access, or will have the same rating as Lancashire. Couple of important points there. And also, these are the bonds issue spreads. You've also got loan costs to add on top of this when you borrow from someone like the municipal bond agency. So that will increase your all-in costs. But it does give an indication that there is scope to undercut the PWLB, or certainly get quite close for some authorities. Although the flip side to this is, if you go to market and say, well, actually what we're doing is borrowing to buy commercial assets, which the market would know is relatively high risk, and also that comes with the loss of the same type of liquidity facility the PWLB provides, that's going to be priced in as high risk. So you will see those spreads push up, and how much they push up, well, it's going to be down to the project, the scale, and the nature of the authority. But these are public bonds we're talking about, so we're talking 250 million plus. But it's a similar conversation with the private placement market and bilateral lenders. And we've spoken to a lot of investors that have just said, hang on, HM Treasury aren't going to support this activity. They've said they don't want to lend to it because it's risky. Why do you think we're going to lend to it, particularly as there's additional reputational risk? And ultimately the risk that if the project and the authority gets into difficulty, HM Treasury dust their hands and say, well, sorry, that's the risk you took. That's why we weren't funding these projects. So it will be more expensive, certainly, to fund those types of projects elsewhere, potentially. Anything to add on that, Nick?
I think, although you're probably correct on what you said just at the end there, which kind of tempers perhaps the positive message given from this slide. I think what's interesting here, and this is something we've always said about the PWLB, is their margin is flat across the whole curve. So it makes it very expensive for the short term, or for short and medium terms, but probably, well, good value perhaps for the longer terms, and it really is shown here. The Lancashire, the short-term bond, got 5 years to maturity, trading below 60 over. So there's definitely, if you've got the size, or maybe the NBA here can fill a role, for kind of this short-term space, where actually there's real value, and that Lancashire bond is still falling. The yield on that's still falling. So what yield could that fall to? And I suppose what would the margin below the new PWLB rate have to be for other authorities to see value in doing that and going through the process in doing that?
Yeah, I think it's a good point on the margin, Nick. And it's interesting, this goes back to 2017. So we can see that this margin does bumble around depending on perceived risk of local authority debt and demand and supply issues. We have seen a period during 2020 where there's a reduced level of merger and acquisition activity and the issuance of paper into the market. So the paper that is issued is rarer and is heavily bid, and that has, I think, been part of the reason that we bond yields driven down and fallen to these levels. And we've been speaking to investors say, yes, let's see how this looks in a few months' time, and it may be that they spike back up. But I think the important thing is there is another way and there is another route, and that's that's the theme of a piece I wrote for Public Finance and our website recently. The bond agency has put pressure on the PWLB, I think, and the Treasury to move faster and further than perhaps they would have done. I think they would have seen local authorities lining up to issue at decent rates. They would have seen the loss of investment, of yield to the Treasury, because obviously they borrow at gilts and lend at gilts plus 80 or 100 or 180. That's a decent margin for HM Treasury, and it also, PWLB loans gives them control of the sector and control of the debt and control of locals to some extent as well. So they wouldn't want to see that flying out to the private sector. And I think that would have forced their hand. So yeah, hats off to Lancashire and to Plymouth and to other innovators and West Berks as well, and community bonds that have said, well, actually, we want to go our own way because we know we're a strong credit, we're well run, we've got decent projects, and institutions will fund us. So I think that's a key lesson. And it would be a shame, perhaps, to lose that, to lose access to the bond agency because they're a few basis points more expensive. I think certainly the likes of Lancashire are thinking strategically, thinking about funding over the long term and giving themselves more flexibility and more choice of who they borrow from. So worth bearing in mind, I think, as part of your strategies going forwards.
It's definitely also worth considering that the PWLB can change policy again. So, we've already seen it go to 180. We've seen changes in, for those that have been around as long as we have, changes in repayment rate structures. The Treasury has full control over the PWLB, and changes are often retrospective as well. So, or have retrospective impact. So sometimes it does make sense to kind of diversify your way out of that policy risk.
Yeah, and we don't want to get bogged down in the circularity of that discussion regarding PWLB, liquidity, access, credit quality, and bond spreads. If Treasury step away from local authorities entirely, then we can be fairly certain these spreads are going up across the board. But I don't think they would do that. I think they've shown some commitment. Certainly at the moment, they're not proposing to do that. So the other alternatives, local to local funding. We showed the aggregates, UK local authority investment balances in billions. September 2020, record highs. We're topping £51 billion here, I think, in terms of aggregate local authority investments, and that cash finds its way to other local authorities. And yes, the figures are slightly lower than they were in March, but still well supported. Local to local funding from your peers. You can borrow from another authority at less than 0.1%, and on our forecast, you'll be able to do that for the next 3 years as well. We don't think liquidity is going to dry up to such an extent that you won't get access to that funding. We don't think the rates are going to go up. And there are plans B and C if that were to happen. So in the meantime, it is possible to continue to do that. And indeed, we're speaking to authorities that had big plans to borrow from the PWLB prior to the rate hike. They were all geared up. They were ready to go. PWLB pushed the margins up to 180 over October 19, and they were very disappointed. And they've waited, and we've advised that we think the rates will come back and the underlying levels won't move. And that's proved to be accurate. And we're now back to those very low levels again. But that same authority is now considering, well, actually, we're borrowing at next to zero at the moment and can do for the next 3 years in theory, versus going to PWLB where you're going to be, cheapest loan is going to be what, 85 basis points, Nick, for a 1 year, and a bit higher. And that's quite a jump in costs, albeit that, of course, you do get that certainty of rates and you lock in and close out risk over the longer term. But there's other ways and cheaper ways of doing that. So I think it's been a bit of an eye-opener in that context, and in terms of innovating and diversifying. I wouldn't throw all of that away. I don't subscribe to the view that the bond agency's dead, or some of these other ideas don't work.
I'd also say, Dave, that in terms of liquidity in the LA to LA market, that the fact that the PWLB have changed the rates, and it's highly likely that some local authorities will now be borrowing from the PWLB. I think liquidity in that market will be supported very well. So actually, if our clients want to continue borrowing, taking the short-term route, I think they will be able to.
Yeah, agreed, Nick. And I think there will be those that fill their boots over the next couple of weeks, perhaps, and then find that they need to find a very secure home for that cash over Christmas and over the Brexit transition period, or deadline. So that money will flood back to local authorities and potentially cause a bit of a glut. And I think that's an important point on the strategy. Well, what is the strategy for locals? I think it's we've had a year off almost where we haven't really been considering PWLB funding or long-term funding. It's been treading water, and maybe that served authorities well given COVID, the delay in expenditure plans and the other aspects that brings. But now it's very much back to getting your capital financing requirement estimates sorted, updating your liability benchmark to ascertain what you need, when you need it, and how long for, and then looking at the market metrics, where we see PWLB versus recent trends, but more importantly, our projections going forwards, and setting trigger levels for action and getting in and borrowing on the dips, hopefully, set a optimistic level. I think, and Nick, tell me if you think I'm wrong, but I think we're going to see sort of Brexit tension increase over the next month, and as we go into the Christmas lockdown as well, and perhaps that forms a bit of a dip in gilt yields and a potential borrowing opportunity if authorities need money soon and have a safe home for it. But the flip side to that is, I think a lot of authorities could probably still extend their short-term exposure and exposure to rolling short-term local authority debt because it is cheap and it is flexible. It's worth having some of that in the portfolios, and we probably still see portfolios that are still too long and too rigid in terms of fixed rate funding, which creates huge investment balances that are invested at some counterparty risk with super low yields that may or may not turn negative at some point over the next few months. What do you think about that, Nick? Did I get anything wrong?
Can I even remember the first part of that, the start of that ramble, Dave? I know. I think you're right. I think you're right on the short term. I think you're right on the strategic. Planning is back. Liability benchmarks now mean something, but I think there is opportunity. You mentioned rates. Obviously, rates are quite close to my heart, as you know. I think there is going to be Brexit. There are going to be Brexit dips, but we've now got the counterbalance of the vaccine coming through. So I think it's fair to say that I see rates being broadly steady. By rates, I mean yields, gilt yields being broadly steady over the next few years. There's a bit of upside depending on recovery from coronavirus, but largely priced in, I would have thought. I think Brexit is now the dampener. So it's whether that comes out better, I think, than we expect. But without a doubt, what we're getting from Brexit, what deal we are getting, as most of our listeners have probably heard already, it's a rather thin deal. So it's not whether it's a hard or soft Brexit, it's just how hard the Brexit actually is. So it will have economic repercussions that will dampen gilt yields going forward, because it basically the MPC, the Bank of England, isn't going to be able to tighten monetary policy for quite some time.
Well, thanks for that, Nick. I'm not going to push you further on Brexit and the interest rate forecast, but we do have that available if anyone is interested. But I did think we'd just have a quick chat about interest rate swaps. I know they've proved somewhat controversial in parts of SITFA's hierarchy, but less so actually. There's more support from some of the Treasury Management Panel members on this. The reason we keep coming back to swaps really are the rates on offer. We're looking at all-in rates here: 5-year, 10-year, 15-year, 20-year terms available. All-in rates 48 basis points, 68, 81, 86, compared to PWLB certainty rates that are significantly higher. So, this is one of the ways we were talking about of potentially closing out interest rate risk, but not taking on that significant additional cost and that 80 basis points margin and paying that away to the PWLB. So savings of 38 basis points through to 83, depending on the term of the transaction. So that's why we still think these are a valid hedging strategy and think there's going to be more interest in these. And yes, this this could apply to a strategy that excludes public works loan funding as well. So if you do think some of your projects are have the risk of being caught and you don't necessarily want to fund with PWLB, well then yes, there's going to be opportunities such as interest rate swaps amongst others that can deliver some of your funding at a lower cost. But even those authorities that aren't conducting commercial activity, investing for yield, well, again, those sorts of savings are going to be pretty handy in budgets. So I think we will see more authorities coming back to this. But we'll probably do an update on swaps at a later stage. I think, Nick, we should conclude maybe just on this slide and then go through and mop up on the questions that have come through. Yeah. But really, I think this is the process. So, you know, we just thrown a load of hand grenade of thoughts and what ifs and scenarios at you. But I think the process is quite clear. Are you going to comply? What's your exposure? What are the options around that? What are the risks? Quantify that. What can you do to mitigate it? And then what are the alternatives if that's a route you want to go down? Or regardless, I think you should be benchmarking PWLB for the reasons we've outlined as well. So that's maybe the key takeaway there. Now, how are we going to do these questions, Nick? Should we go through? I think you should answer one and I'll read the next one, and we'll do it like that. I think we've dealt with Dan, so hopefully he's happy.
So Rob, a really early one actually, so sorry it's taken us a while to get to this. Do you think green energy investment falls into the category of preventative action? Well, Dave mentioned previously about knowing the specifics of any project before being able to actually give a definitive answer. But I think it has to fit into one of the categories, and I'm not sure green energy investment does. I don't think it fits their criteria unless you're saving some kind of project that you feel is fundamental or vital to the local area. So it's just the same kind of preventative action as any others. I think green energy investment could be regen if you're building new. If you're buying what's already there, yeah, I think that just falls into the grey area, really. I think that's quite a difficult one. So I'll leave it there. An inconclusive answer, but I think, yes, we probably need to see a bit more of the details of what the investment is before you can actually say, is it preventative action? Is it regen? Yeah,
and again, that's one of the services we can provide. But I think we covered Chris's question or comments. Lee Walker, regarding housing and housing, if housing is being acquired to let out at market rates, I think this straddles some of those categories, clearly the housing category and the yield aspect, and I think would need more details about the fact that it's being acquired rather than built would be raise a flag with me, perhaps. We're not talking about potentially any additional modification to those properties. It's at the market rate. It is looking suspiciously like purchases for investment yield. But again, we would need a bit more detail, and if it was structured slightly differently or presented in a slightly different way or had those additional construction or modification aspects, then perhaps it would pass. And I think, again, scale is going to be important too.
I think housing as well has kind of its own special category. So there might be slightly more leeway with housing than there would be with any other kind of commercial. But still, I kind of agree with Dave there. I think if it was just doing that, perhaps you'd have to do something else to that scheme to make it fit into kind of regen or something like that, or the housing category.
Sorry, and I agree with Dan Bates's comments that I think if you do you're seen to be doing commercial activity or the HM Treasury gets wind of it, there will be closer investigation. Pradeep's question is interesting on the internal or external auditors. Who's going to be checking your process for categorization? Go for it, Nick. I've got my view, but
Yeah,
well, I think they were referring to external auditors personally.
I think in general the Treasury generally referred to external auditors, but it's probably both, to be fair. But yeah, definitely external, because obviously I probably won't go down that route. But yeah, definitely external from the Treasury's point of view, I would have thought.
And I think Vicky's point on building houses for market sale, I think you're on safer grounds if you're building something. Probably should flag up Croydon and brick by brick. You know, I think it comes down to scale and how that's applied, and how commercial it is, and perhaps how prudent it is. But I think where you've got a mix of affordable social, it sounds more beneficial, more like the sort of thing a local authority should be doing, and using money, public works loans, board money for that type of scheme. Vicky?
Yeah, I agree with that. And in fact, the Treasury seemed to allude to that in the guidance and in the consultation. So I think where it's a mixed scheme, it's on firmer ground, as you said, Dave.
But yes, on comments on alternatives, yes, I think there will be these alternatives, but I think there's potentially offers out there at the moment. But I think once you start scratching into those offers, there's going to be quite a few strings attached. You're going to be potentially looking at a more commercial way of borrowing once you're outside the PWLB, and there are clearly certain things a local authority can't do in terms of offering security, etc. But there may be a more requirement to put loan covenants into, increasing the number of loan covenants into documentation that restricts how you operate and what you can do. Certainly, I've seen an offer to one of our clients for commercial purchase, but it's we're then into referencing loan to values and only supplying 70% of the value as a loan, and local would have to go elsewhere to make up the rest. And we're into those sort of very real project-based decisions and funding constraints and parameters that lenders are going to want to see, and potentially guarantees as well, which kind of get you back to the same sort of thing as if the local had borrowed, and clearly there will be a cost to that. And worth highlighting, a lot of the schemes we saw them were proposed had fairly skinny margins associated with them, so you don't need to push up the funding cost too much before you have to start to question the viability of these projects and schemes, particularly if it's not just the schemes affected, it's also the funding of the rest of your capital program, and potentially refinancing as well. So that's part of that risk assessment and exposure and appraisal process that locals will need to go through. But I think there's a lot of conversation, a lot of chat about debt yield. I don't think there's a huge amount going on. We did see a big drop off. We've got 180 local authority clients. I would have thought, I don't know, Nick, maybe 10 authorities still pursuing actively these projects, and of those on a reduced scale, and some of those are at stage 3 of committed projects. They're in so deep they can't pull out and leave these projects incomplete, so they need to get them finished off. But I think it is on a downward trajectory. But clearly there will be other opportunities and structures that pop up, but with added risk for locals and the sector.
Jason's asked about regen, or at least commented about regen requires holding assets, long-term recycling income. I think that's included really as part of what the Treasury see as regen. They made the point that if you're you can get involved in that kind of purchasing as long as the income doesn't support wider services, as long as it's flows back into that project or projects that are similar to it. So again, the narrative is really important. The links between various parts of the project are really important. And I think someone further down has mentioned, or somewhere in here has mentioned, that the kind of reports going to council really need to major on the impact this is having rather than any financial benefits that may be generated.
Pradeep's question, would the refuse only be for the contentious scheme or the whole scheme? Well, it's the whole scheme that would be, you wouldn't have access to PWLB for that entire scheme without that consultation that Nick's mentioned, and they'd probably ask you to take the offending scheme out, to be frank. And Vicky's point on premiums and discounts probably relates to my comment about how you can structure PWLB to reduce that penalty risk. And Vicky, we'll probably talk to you individually about that. We've got a few plans that we're going to go through with clients on how to mitigate the risk and potentially reduce the costs for those that are concerned. But it may be that those strategies are quite sensible for any authority, but yeah, we're just working on some of those, and maybe that's something we didn't mention in too much detail, but I said PWLB still isn't brilliant. Nick made the point about the margin applying all the way across the curve. We did put in our response that perhaps we should have a tapered margin, so it's much lower cost at the short end or for variable rate debt. It's just hugely expensive. It's ridiculous. Anything less than 5 years from the PWLB is a joke, and that's why there's an active local to local market. And indeed, if that market stumbled or dried up, there'd be a commercial paper market that comes in and fills the. So that's one of and the other one that it's huge lower levels to repay and restructure debt. It's a massive straitjacket, and there's a lot of other ways and better ways of structuring debt and funding that don't tie you to those huge redemption penalties if things change. And it's those projects, those types of ideas that we think might be more beneficial going forwards, particularly if there is a slight risk of being caught out on some of this.
Indeed. Dave, you can take Joel's, is it?
Yes,
Alan,
Joe. Hi, Joe. Do you think institutional investors will try to compete with the P or keep the rates higher? I think this is a trick. I think the institutional investors would love to compete. They've got used to the credit risk and the asset class, and the ones we speak to are lapping up the paper, and certainly those public bond investors couldn't get enough of it. But there will be an adjustment for risk, and it will be the riskier authorities by the nature of operating outside the PWLB's rules and the schemes employed that are coming to them. So yes, they will be a spread above PWLB rates. I think for most institutional funding, there may be an outside chance of doing things like green bonds or other highly sought after investments, borrowing issues, tranches of funding that have an added benefit that perhaps investors won't mind sacrificing a bit of yield on that comes inside PWLB. But I think it will take a while for the market to settle down and digest this and get their heads around what it means and start to see those projects coming from local authorities. But we're already speaking to a couple of investors about a couple of projects. But yes, the yields are higher. But I think the general yield, putting investment assets to one side, I think if it was for a local authority that is compliant with PWLB, we probably will see those yields drift down, and they may become competitive again in a few months, depending how the market develops. Nick, are you okay to answer Michael's?
Which one? The
member approval report for a scheme will be key in setting out the service delivery objectives as well as the financial aspects.
That was the comment actually, Mike. I was referring to further up when I was talking about narrative. I think you're quite right, and actually Michael's got another one further down, which is a question. which again is a difficult one, firmly placed in the grey area. Would a developed green energy service rather than a yield? Well, I don't know actually. It depends. The Treasury have made quite a big deal of where services fit within your returns to them. So I guess if it fits in the return for services, then you've got an argument. But is it a statutory duty or is it a local policy? And is there a difference between the two? You could say it's a local policy to buy investment assets primarily for yield to support service, what the wider service is. So I think that's difficult to say actually. Again, I think we'd need more specifics around what the service is and how it's been presented before you can actually make a judgment there. Dave, any comment?
No, I think that's fair enough, Nick. And then Lee's point on the Prudential Code, will it reinforce the PWLB HM Treasury's position? I think yes, it will. I don't know quite what form that will take, but if this activity continues and HMT think, well, we've changed the system and it's still being abused, what are the other options? And the Prudential Code, borrowing caps, rules regarding MRP, other aspects that regional governments might come up with as well. That all that will come to bear, and some of it might be being prepared anyway, given the parliamentary committee report into local authority investments, and that was one of the outcomes from it. The system needs to be reviewed and beefed up to stop the perceived abuse of lending arrangements and the accumulation of too much debt at local authorities. So yeah, I think you can expect that. Oh, and Vicky just points that out, that the Treasury codes and approved code are being updated. I know it's on the Treasury Management Panel agenda as well at CITFA.
Okay.
We will email well, actually, we won't email the slides, but if you ask us to, we will send them to you.
I think Nick's is the last question. Any problems about buying property funds for treasury management purposes to increase yield and diversify? That is an interesting question, Dave. Well, as long as I suppose, looking at it very technically, as long as the investment you're making isn't capital expenditure, then it won't appear on any capital plans. So there's nothing to declare, I guess. I suppose you can also make the argument that perhaps you're investing the council's reserves. So on that basis as well, it's really up to you what you do with the council's reserves and how you invest it. Yeah, I think you're probably all right with that, but I think you'd have to package it up, and the narrative would have to be quite strong around it. Any comments, Dave?
No, I'm inclined to agree, and I think we need to separate treasury management and the investment of your reserves and balances in sensible assets that actually have a realistic chance of keeping pace and exceeding inflation. That's type of discussion and treasury management activity is quite different from levering up and increasing debt to buy assets to generate yield, and it's probably useful point to close on. That is the activity that Treasury want to stamp out, particularly that activity on a large scale that risks the authority. And yes, there's a lot of rules, there's a lot of what ifs and buts, but I think probably most authorities will know and will be able to get a feel for, is this acceptable, or are we misusing PWLB, and go from there really. So perhaps we'll leave it on that. Suffice to say, Arling Close execs and staff happy to speak to you individually about this, and yes, we'll be providing advice on how to access PWLB and what you need to do, and setting out strategies over the next year. But thanks everyone for joining, and sorry we went on for about an extra half an hour, but there we go. We should mention next week's Trending Treasury, which I believe is on section 114s. So hopefully you see a lot of you again at that. And that's about it. So thanks, Nick. Thanks for joining me on that. And thanks to everyone else. We will see you next time. Thank you.
Thanks. Bye, everyone.